Good morning, everyone. Happy Wednesday, and thank you for joining us. We've got an hour of fun ahead. I always say this is the fun stuff, reverse and improvement exchanges. Something that requires a little bit of gray matter to get through, and I'm hoping that you've got a good base of knowledge for 1031s. We are going to start off by covering the basics, basis gain, things to consider, why we're actually doing the exchange. We'll talk about some of the trends, what's going on, but with complicated times, we get more complicated transactions, it seems like, and that's where we are today. I'm David Moore with Equity Advantage, and we handle tax deferred exchanges. And my objective today is to give you some nuggets of knowledge, something you can use, and whether you're an investor or a broker trying to get deals done, like I said, it is a more complicated time right now. Money is getting more scarce, and there's a variety of reasons people are trying to get from here to there. I think a common theme is moving from states of lower ownership rights to states where we've got greater ownership rights. And the funny coincidence about that is typically the greater ownership rights, also the lower taxes, and so on and so forth. So you can sort of look at your tea leaves and understand where things are headed. If you are in Oregon and you are a broker and you need CE or would like CE for this, it's good for 1 clock hour. You can reach out to C Moore, C-M-O-O-R-E at 1031exchange.com, and she can take care of you. I will probably not be covering questions that you've got in that side during the presentation, but we can respond back afterwards, and the slide deck will be available for you. So we are going to have some fun, and it's all about getting some tools to get those deals done today. So you've worked hard for your money. We work hard to keep it yours. I want to say that whether we're talking about tax money and basis and gain situations requiring 1031s or qualified money IRAs and 401k plans, going to use those funds to go invest in things Wall Street does not sell. We do not provide investment advice, nor do we sell investments. We are just the conduit out of what you don't want into what you do want, whether we're talking about 1031 or self-directed retirement accounts. So you'll hear me say during the class, the only dumb question is one you don't ask. If you've got questions, please never hesitate to reach out. We want to be here and help you get where you want to go. So, whether looking to do a 1031 exchange for gains on the sale of investment property or considering the use of IRA 401k funds to make off Wall Street investments, we're here to help. We do not sell investments, nor do we provide investment advice. We have one objective: to provide solutions to your investment needs. And I want to stress, in today's world, it's a complicated world. You need a good team of professionals on your side. I think very good tax people are probably one of the most important people in your life. When you're contemplating any transaction, whether it's using qualified money to make investments or doing a 1031 exchange, you need to consult those professionals prior to making things happen. If we're looking at making a retirement account investment in a piece of real estate, for example, it's going to take some time, probably several weeks, to get the account set up and ready to go make those offers. It's important that you get ready before you go out and jump to find that stuff. And we do a lot of advertising on radio, and it's sort of funny because we don't hear we don't get the calls when people hear the ads and start sort of that seed gets put in their mind. We get the call when they found the property they want to buy, and now they're needing earnest money, and really you need to be ready to make that investment. 1031s over 100 years old at this point, and you'd sort of hope that there'd be a better level of knowledge there on its application, but unfortunately, even after over 100 years of time, we get calls all too often after a closing has occurred, and it's too late to set up the exchange at that time. We're talking about reverses today, and it's also a situation, unfortunately, that we've seen happen over the last year as the markets have tightened. Maybe financing blows up on a sale property, and you've got that target property in mind. You want to go ahead and somebody says, well, hey, just buy it today and do the reverse later. Well, you can't own the new and old property at the same time. So whether you're selling or buying in a reverse or any transaction, if you want to do an exchange, the transaction has to be set up as an exchange pre-close. So I'm going to say that again. Let's say, for example, you're entering into a reverse. Maybe it was structured as a delayed exchange. Your relinquished property did not get closed. You still have the ability to go buy that replacement. Don't close on it without engaging us. We have to be involved prior to that close because you cannot legally own the new and old property simultaneously. And it's happened way too often in the last year where people just say, hey, my sale blew up, I'm going to go ahead and buy, and then when it sells, I'm going to do the exchange. It's too late. Make sure that if you're looking at those transactions, people ask me all the time, when do I want them to think about an exchange? I'm going to say before you ever make a purchase or a sale, you want to contemplate what's going on. If it's a sale, you want to talk to your tax people, understand what the tax obligation is going to be on that sale, because there is an opportunity cost to Section 1031. And say, David, what's that? What's that mean? What are you talking about, opportunity cost? Well, the opportunity cost, for anyone that's been in an exchange, you know that time is really a ticking time bomb. You've only got 45 days from settlement to ID what you want to buy, 180 days to close on one or more of those properties you've identified. In a reverse exchange, we're looking at the opposite. From the date of acquisition, you've got 45 days to identify what's to be relinquished, 180 days to get rid of it. You just don't want to put yourself in a time crunch if you don't have to. Now, one other comment I've got on reverse exchanges. Just because they're there doesn't mean you should use them, right? So what I'm going to tell you is ask for the time you feel you need to get that purchase done. Use the reverse as a fallback, not as a primary objective. And I say that for a variety of reasons. One is just sheer cost, where you can do a delayed exchange for as little as maybe $1,000 for both the sale and the purchase. Reverses are going to start off probably closer to $6,000 or $7,000. So it's a big difference in cost, but that's just the transaction cost with us. You may have other costs associated with that reverse exchange with more expensive financing, for example. And we'll talk about how that finance piece comes in on what's called a warehouse replacement reverse exchange. And just for the sake of the conversation at this point, a warehouse replacement reverse exchange means that Equity Advantage is going to take ownership of that new property at time of close. And you can imagine if you go talk to your friendly lender and say, hey, I want to go buy this property. Oh, by the way, I'm doing a reverse. And oh, by the way, I'm not going to take ownership at the time of close. Well, that lender, if they're not familiar with what's going on, is probably going to be scratching their head. And I'm going to tell you that if you go through a national bank, for example, they don't have a box to check on that loan application for reverse exchanges. So really talk to your professionals, talk to the experts in your life prior to getting involved with these transactions, so we can really look at a deal and rationalize the best course forward. All right, so you want to plan what you're doing before you're in a spot where you have to make things happen. And that's why we're here. And I encourage you, and I've said this before, even if you're working with another company, if you're not getting answers to questions, give us a call. That's why we're here. And by the way, if you take a look at, we've got our website at 1031exchange.com. is very, very thorough on information. It's got a lot of information, a lot of different aspects. If you are wanting something more than that, go take a look at our YouTube channel. Our YouTube channel's got several hundred videos on there, all aspects of 1031, obviously. And we also have information on there from everything from cost segregation to selling life insurance contracts, charitable remainder trusts, opportunity zones. And a lot of that stuff isn't anything to do with 1031s even. It's just there to provide you information if you're an investor or you're a broker on things that are possible end games on 1031s that can contain a variety of different things. But you can take a look on that YouTube channel. Just type in Equity Advantage 1031 on YouTube. You're going to find, if you got IRA 401k questions, you can just type in IRA Advantage self-directed retirement accounts. You're going to find us there too. So you're going to be listening to David Moore. I'm one of the founders of Equity Advantage. My brother and I founded the company in 1991. And we've had a lot of fun through the years. We've got a lot of great relationships in the real estate world, tax and legal worlds through all that time. And I just look forward to, working with you guys going forward, and I hope you get a lot of information out of today's class. Thank you. So why do we even think about this? Why do we even think about an exchange? And it's a simple question. It's a question of gain and tax. And why would you pay tax on something if you didn't have to? Every dollar you save on a sale is going to allow you to spend $2, $3, or $4 more on the acquisition if you look at loan to value and leverage. All right. So the idea is, and this is one of those things where you don't have to have a profit on a property to actually have a tax consequence, because when you buy a property, you're going to, if it's an income property, for example, let's say a rental house, you've got depreciation that you have to take. And you say, well, gee, Dave, what do you mean you have to take it? Well, the idea is depreciation is not optional. If the government's position on it is, if you should have taken depreciation, you did. So back to good, competent tax counsel. You heard me mention cost segregation when I talked about the YouTube channel. If you look at cost segregation, what is that? Well, I mean, if we're looking at cost segregation in the most basic sense, with a rental house, you've got an allocation to the dirt and to the improvements when you buy that rental house. And that's the most basic sense. Okay, what happens to your return on investment if you jack up the value of the improvements versus depreciating, not depreciating, but reducing the value of the improvements? The greater the improvements, the more depreciation you're taking, the better your ROI is. Okay, so cost segregation would be used typically not on houses, it could be, but on let's say the office building I'm in today. Instead of using a dirt and improvements cost seg, you're going to look at cost segregation study that busts this thing up into 200 different components, accelerates the depreciation, greatly changes the return on investment over a shorter period of time. So just be aware these things are there. Who are you going to talk to about that? You talk to your tax people about it, and reach out to a cost seg specialist, and they're going to help you with those things. But that one element is why good tax people are important. So if we look at gain, it's simple calculation. It's the adjusted sales price minus the basis. Your basis in a property is what you paid for it, plus the capital improvements minus depreciation. Now, if you look at this page, after the purchase price, I have an asterisk. After improvements, I've got an asterisk. After depreciation, I've got an asterisk. Why do I have those things? Because it's not that easy, all right? When you look at that purchase price, it depends on how you bought the property. So if you just pulled money out of your pocket, the purchase price is a purchase price. If you bought the property through a 1031 exchange, you had a basis carry forward. 1031 is a not tax-free exchange, it's a tax-deferred exchange. The basis and gain goes forward through your investment life of 1031s. All right, so the purchase price can vary depending on how you buy the property. If I gave you a property, your quote unquote purchase price would be, maybe the basis that I gave it to you at. If I passed away, you inherited, you got a stepped up basis, that would be quote unquote the purchase price, in this context. 1033, involuntary conversion, basis carry forward, just like 1031. If you bought something pre-1997, we used to have what was called a 1034, and that was a residential transaction, an exclusion that existed pre-Section 121 in 1997 took its place, but 1034 was the basis carry forward. You had 2 years to buy a new home of equal or greater value to what was sold, and that basis would have gone forward, and quote, therefore that purchase price would have been slightly different for calculation numbers. All right. Then you start looking at improvements. So the purchase price plus the capital improvements during the time you own it. Now, I talk to people every single day. I talk to them, okay, when you bought the property, or let me ask you this, anytime you've ever bought a property, or for the brokers out there, anytime you sell a property, what's the buyer do? They typically are going to inject a bunch of money into that property, improving it. Now, I'm going to back out of the presentation just real quickly, and I'm going to do this because 1031 is once again under attack, and this time it's not getting rid of it. Once again, they're now looking at capping your annual deferral. So they want to cap what you are able to defer in a given year. And that's very problematic, because what it will do is it'll stifle the liquidity of the market. Now, if you reduce the liquidity of the market, one thing you just got to look at, and every time we elect a new group of, I'll call them knotheads, into DC, I feel like we have to fight this fight, and we have to show them once again, if you eliminate the liquidity, you not only have a problem, you increase the taxes, you actually reduce what they're going to get out of those taxes. So their tax calculations are totally flawed, and we showed them that over and over and over again. As a real estate industry, as a 1031 industry, fortunately, National Association of Realtors, we've all fought to keep 1031 intact. So one, they're just wrong in their assumption that by let's say increasing gains, they're going to get more, or if getting rid of 1031, they're going to get more tax revenue. It just doesn't happen. But the other issue, the bigger issue, I think, in today's world is we're at a point where older buildings are having a harder time all the time getting financed or getting insurance. And the quality of the real estate declines if you reduce liquidity. So it's really important just for those BC properties to keep them vibrant is you got to have them turn over. So we're talking about improving properties. Now, why I sort of sidetracked it there is when we look at improvements, I talk to people every day that I ask them, okay, when you bought it, you paid this for the property. During the time you've owned it, I know you put money into it. What'd you do with that? And he said, oh yeah, we did all these things. So we did all these capital improvements. So, okay, did you write any of those off? Oh yeah, we wrote off all of them. Well, you didn't capitalize those, then you expensed them, and it doesn't increase your basis. So every dollar you put into it, you either expense or capitalize. If it capitalizes, it increases the basis. If you expense it, it does not. Finally, we're going to look at that depreciation. I made a comment a few minutes ago about depreciation. It's not elective. If you've got a building that is occupied, then that depreciation, the government's position is you should have taken depreciation, therefore you did. So whether you took depreciation, got the benefit of it or not, you're going to be accountable for it if you were audited and they wanted to give you a hard time. So once again, it's really important you have good tax people in your life to make sure things are going forward. Now, if we're looking halfway down this page, this is something that really reached out and bit people in the last crash, and I'm very leery of it going forward. Now, people think, well, I didn't make money on this property. How can I have a tax consequence? Phantom gain occurs when the debt on a property exceeds the basis. So when we're looking at that basis and gain, it's the adjusted sales price minus the basis, and that gives you gain. Well, in a foreclosure short sale, if the debt's over that basis, the debt is treated as the sales price, and you can lose a property foreclosure and actually have to pay tax, even if you didn't get a penny out of that thing. So you could walk away with nothing and have to pay taxes for the pleasure of doing that. Now, on a primary residence, you've got tax relief. Income properties, you don't. So make sure that before anything ever goes away, whether you're selling it or it's foreclosed or there's a short sale, you got to reach out to your tax people and understand what the tax consequence potentially of that transfer is going to be so that you're prepared to take care of it. And we're going to give an example later on with a phantom gain transaction where we actually set up, and the examples at the end are actually all deals that we've done. But phantom gain transactions from the last crash where we would step in a property to be transferred to us pre-foreclosure, that transfer date starts the clock. And it's really sort of funny because typically in a delayed exchange, we're going to have a sale, we're going to have money come into us, and these transactions, no money comes to us. And we're just isolating the taxpayer from actual constructive receipt of debt relief. So it's a totally different idea there, but it's something to be aware of. So what do we worry? Why do we worry about basis and gain? What kind of taxes do we look at? Typically, we're going to look at federal taxes of 20% on appreciation, 25% on depreciation recapture. States are going to hit you on top of that. So if we're looking at Oregon, for example, could be from 9 and up to almost 12% these days. Washington, at this point, we're still in a situation where there isn't any tax. You got a 3.8 healthcare tax that got put into play when President Obama was in there. It's still there for people that make enough money to have that bite them. So if we're looking at tax consequences, you could have as much as almost 40% just in capital gains, depending on what type of gain that is. And if we look at this map, you can sort of see state by state what those state tax rates are. And please keep in mind that where the property is, that's where the gain's going to be triggered. It's not where you're living. You can't say, well, gee, I live in Texas, I don't have any state tax, So when I sell in California, I'm not going to have to pay the 13.3. That's not true. You're going to, you got the pleasure of dealing with Cal Franchise Tax Board for the 13.3, and regardless where you live. And I guess a comment I've got lots of people buying into Delaware statutory trust today, or institutional tenancy and common transactions. But DSTs, for example, you can sit in a situation where if you're working with a let's say sponsor that hasn't been in that business very long, most DSTs are probably multi-asset offerings. And if you look at Delaware statutory trust, it contains maybe 10 properties. Imagine if those 10 properties are in 10 different states, now you have 10 different tax returns. So just be aware of that. The sponsors have been around for a while. They're going to put you those 10 properties more often than not in one state, so you don't have 10 different returns for that one DST offering. But that's just one of those things that people don't really think about. And I'm going to tell you, don't, I always say I'm happy to learn, tired of being taught. So, really take advantage of the experts in your life and their experience. Don't get yourself in a situation where you're going to have to pay for something that you weren't expecting to have to deal with. If you're wondering why, for example, Washington has that band up there, I mean, we've got a couple states that have those bands. Washington State, they're going to tax you differently, whether you're talking about real estate or, let's say, for the Microsoft and Amazon people, that they put a capital gains tax in play to get the gains off those stock sales. But that, at this point in time, for future context, we're talking May of 2024. At this point, real estate's still exempted from that state capital gains tax, which is sure nice. And hopefully it'll remain that way. Exchange fallacies. We're going to talk about a few things real quick that just be aware of, that people say that are not true. A lot of times, and I've been doing this a long time, I always joke I had a lot more hair on my head when I got started, but sometimes they have people say, well, gee, I remember when like-kind meant house for house, land for land. It's never meant that. Like-kind is always referred to the nature of the investment rather than the form. So you can go from a rental house into apartment buildings and office buildings, a place to retire into. Land, it really doesn't matter. You're just saying any real property held for investments, like-kind with any real property acquired with intent to hold for investment. And we're going to talk a little bit about time on that topic too in a few minutes. Second, 1031 does not require a 2-year hold, and so here I go. I said a couple minutes, but I'm right here. There's no 2-year hold on 1031 outside of related party transactions. So if I want to, let's say, exchange properties with my brother, we both would have to do exchanges, and we both have to hold our respective replacement properties for no less than 2 years. Now, if you read the fine print, you're going to see that it says, unless there was no intent to avoid tax. Some people would say 1031 is tax avoidance. I'm not going to say that. I'm going to say it's tax deferral. The gain doesn't go away. The only way it's going to go away is, what do they say about life? The only sure things in life are death and taxes. Well, that tax could go away in today's world. And once again, for future context, May of 2024, we still have a stepped up basis. What I'm talking about there is you can swap, do exchanges through your entire life at this point in time. And when you pass away, you become an angel. Your heirs can receive those properties stepped up basis and then sell with no capital gains tax. So you have to look at and sort of balance the tax deferral via 1031 and the stepped up basis, and look at the value of your estate and what state or federal laws might approach you on that. And we have a number of people for estate planning purposes may be gifting interest in a portfolio of properties during their life to get their estate to a level where maybe the state doesn't ding them, because states like Oregon, for example, don't follow the federal guidelines on estate taxes. And you're actually, believe it or not, you're better off passing away if you're a higher net worth person passing away in California than you are in Oregon. Sort of funny, but anyway, funny or sad, I don't know. So when we're talking about hold periods, there's no required hold. If you ask me how long I want to see you hold something, I'm going to tell you a year based upon 2 factors. 1, that's been proposed a couple times. 2, that's the break between short and long-term tax rates on assets held for investment. Who am I to argue with the federal government? If you want to see more on that, you can take a look at your YouTube channel. I think we did a video. I think it's most viewed video we have. It's a fallacy of the 5-year hold, but we talk about this a little bit further there. And just so you understand what I'm talking about, the 5 years. 5 years applies to a property acquired via 1031 and subsequently changed into a primary residence and later sold. If you sold that home, let's say you do a 1031 into a property that's ultimately going to be your home, you buy the property, you hold it, let's say a year as investment, then you move into it. And if you sold it within 5 years of acquisition, it'd be a fully taxable sale. After the 5 years, you're going to be subject to something called the Housing Assistance Tax Act of 2008, and that really sort of ties your hands. So don't think you can just exchange out of an income property into a place at the beach, hold it a year, move into it for 2 years, sell it, and take the exclusion, get rid of your gain. That does not work. Check out the Housing Assistance Tax Act of 2008. If you want information on that, give us a call. 3, there is no limit to the number of properties relinquished or received. The identification rules seem to imply that there are, but it's really wide open with respect to the number of properties. You can relinquish a dozen properties, buy a dozen properties, relinquish a dozen, buy one, relinquish one, buy a dozen. It's really wide open. The identification rules do tie your hands with how you can identify things and how you can safely get the deal done, but there's no limit to what you can relinquish and receive in one single exchange. 4, you can carry a note or land sale contract and still do a 1031. Now, that's something we hadn't seen for a long time, but in the last year, all of a sudden they're in vogue again. And I've got to tell you that selling and doing an exchange, if you sell and carry a note, doing an exchange, they're very problematic. So you got, number one, I'm going to tell you, it's your note. Make sure it's drawn by your people. Don't let the nice buyer create that note, because that note might not have acceleration provisions. It might have a right of assignment that you didn't want. So it's your paper. You make sure you take care of your needs. Now, so selling, carrying paper, doing an exchange gets pretty complicated, all right? If you sell and carry a note trust deed doing a reverse exchange, it's very doable, and we're going to get into the details of that a little later. Buying and having a seller carry is totally fine. It works great. I don't care where you get the money to buy the property, as long as it's legal, totally fine. So if you're in a situation where you've got a seller that wants to carry paper, maybe they want that installment sale treatment over time, great, that's wonderful. Just a couple words of warning on that. If it's an end game for you and want to carry paper and just get installment sale treatment, make sure you understand you're going to have tax on debt relief and depreciation recapture in the year of disposition, whether you receive a single principal payment or not. So if you're going to sell and carry a note, you better get enough to carry or to cover the broker's costs, the title escrow costs. If you're doing an exchange, our costs, any tax and legal costs there, and then any tax on debt relief and depreciation recapture. So those nothing down deals, I've been around them, and it's not very fun when all of a sudden the seller is trying to figure out where they're getting money to pay those things. So make sure if you're selling and it's your paper, you really contemplate the actual consequences of that action. And as I said, if you're doing it because it's an end game, you want installment sale, make sure you've got an acceleration provision that's going to protect you from having that thing paid off, because when it gets paid off in the future, we cannot do a tax deferred exchange at that point. We've got a page talking about options on notes in a few pages from now. We'll get there. All right. You do not have to replace debt in an exchange. So what's happening in the lending world? We've got decreased loan to value there. We've got values that might be dropping in some instances on properties. Maybe you're having to inject money into a purchase to make that happen, or maybe you don't want debt on the replacement property. Totally fine. You can add cash, so you can offset debt relief with cash. You can't offset cash received with debt. So what I mean by that is you can always put money into a property on the replacement side. Debt can go away two ways, one by going down in value, the other is by adding cash. Adding cash is fine, going down in value triggers tax consequence. And then finally, 1031 is not all or nothing. Every dollar you spend over your basis represents tax deferred gain. You don't have to do it all. If you want to pull 100,000 out, go buy a car or something, you can do that. All right, you're just going to have tax on that 100. Every dollar spent over the basis represents tax deferred gain. So holding periods, this is a court case where a matter of months was actually long enough. And I just give this to you because that misinformation out there on holding periods, I get comments about 5 years, I get comments about 2 years all the time. And as I said, in a related party transaction is a 2-year hold. An arm's length transaction, there's no required hold. It has to do with intent, not time. Now, the Racine court case is a situation where somebody did an exchange into a property, held it a matter of months, moved into the property, they got audited, taken to court, prevailed in court after I believe it was just 4 months time. And what they argued, they documented the listings for rent, they documented showings for rent of that replacement property, and they couldn't get it rented out. Well, they were in a financial crunch. They argued they couldn't own the new investment property and their home at that same time. So they opted to move into the property and got rid of the home, and they actually took it and took it to court, prevailed in court after that period of time. As I said earlier, I'd like to see a year, just for those reasons I previously mentioned. I think it's defendable, and we've got a couple reasons to point at it. If it's a related party transaction, you probably ought to honor the code and have the 2 years. And we're going to talk a little bit more about related parties in a while. So basics to this whole process. One, it's got to be an exchange. Something is going to be given away and something's received. So you as far as the taxpayer is concerned, they're going to sell something and they're going to buy something, and we're going to turn it into an exchange for them. But really, if you look at it, what an exchange company does, we're an exchange facilitator or accommodator or intermediary. All right, we like to call ourselves facilitator because a lot of companies in our business, honestly, these days just handle paperwork and, yeah, you got a sale pending, tell us, give us who's handling the escrow and the closing number, and we'll drop our paperwork and isolate you from tax consequences. We don't look at it that way. We really feel it's an investment decision. You got to rationalize what you're doing and make sure that it's the right thing for you. And sometimes 1031 is not the right thing for you. So anyway, understand, one, it's an exchange. Two, what's given and received have got to be a like kind. We talked about it, nature of the investment rather than the form. Three, for total deferral, we need to satisfy what we call the napkin test, which says across or up in value and equity. I did not say anything about debt. Remember, debt could go away 2 ways. One, by going down in value, triggers taxes, you went down in value. The other way is by adding cash to the transaction. And then finally, we've got to have continuity vesting. Now, anybody that's done an exchange knows that time is the biggest headache. Vesting is a bit second biggest. And why vesting just means that the taxpayer that relinquished a property has to receive the replacement property. Title doesn't necessarily indicate ownership. Benefits and burdens of ownership do. And where that vesting piece gets to be such a problem is, for example, in Oregon, we're not a community property state. So even spouses, you could have a husband and wife own a rental house, and they get another one, then they get another one. Then their lawyer says, you got liability there, let's shove them into an LLC. So they do that, and then that husband and wife sells that property in the LLC's name. The LLC in Oregon's a legal partnership. So that LLC would have to be the buyer of the replacement in Oregon. Now, if we're in Washington or California, it wouldn't have to be that way because those are community property states. So a couple can go out into and out of an exchange, into the exchange and LLC and out of personally. Where that's important is if you're doing 4 units or less on acquisition, typically that's a residential finance situation. And if you want to go buy that same property in an LLC, it's going to be more expensive money. So that's just an example of how quickly vesting gets to be a problem if you're not prepared to deal with it. So just understand that. But vesting is going to be the second biggest problem with any exchange, second only to time. This slide, when can I get my money? This is something I really want to stress right now, because when you enter into an exchange, you are married to that exchange company until you've purchased everything you have the right to buy. There's something called 1031-G6. There's also something called an accommodating accommodator. You don't want to work with an accommodating accommodator, and you think, well, gee, maybe I do, because hey, an accommodating accommodator, if I call them up, say, hey, I don't want to do the exchange, you're going to give me my money. Well, they might, but they should not, because if they're working outside 1031-G6, their exchange policies and procedures are not valid, and therefore every exchange they do using those policies is invalid. It's not just your transaction, it's everything. So anybody that does this and honors the code and works within the code is going to say that you can't receive your money prior to receiving all properties you have the right to buy. Now, What does that mean? That means that when you enter into an exchange at close, that money comes to us. You cannot personally receive any money, no matter what, inside that 45-day identification period. So during that 45 days, you're going to identify what you want to buy. You're going to work with one of the identification rules. And it's important that you identify only what you want to buy. Now, if we get to the 45th day, do not identify something just in case. If you're not sure you want it, don't identify it. Just, and even if you've identified something and you decide at the 45th day you don't want it, rescind the identification. On day 46, we can give you your money. If you don't rescind that identification on day 45, and let's say on day 60 you find a property you really want to buy, we cannot give you the money for that property. And you say, well, gee, David, what happened to the property I ID'd? It got sold to somebody else. I can't buy it. Well, it doesn't matter if somebody else bought it. A property doesn't have to be listed or on the market to be identified. So it's really important on the 45th day, you're either committed to completing the exchange or you should terminate it on day 45 by rescinding the ID, and we can then get your money on day 46. Now, if you've identified something and you decide you don't want to buy one of those things you've identified, now we can't give your money until day 181. So it's really important you understand that and really work to get things done. So I'm going to tell you, from the moment you list a property, you're going to be looking for the replacement property. You can go ahead and negotiate the purchase, write the offer, do everything short of close on it, and you're fine. Now, if you have to close on it before the sale, that's why you're on this class today, because we're going to talk about reverse exchanges, buying before a sale happens. But really understand 1031 G6 and what it says. Anybody that is a legitimate exchange company is not going to give you money outside of this 1031 G6. And I just mention it because we are in a market where more transactions are not being completed. And it's really frustrating when somebody has money stuck here. It's frustrating for the taxpayer. It's really frustrating for us. We don't like that situation any more than the taxpayer is, but our hands are tied. Partnership exchanges. This comes up a lot right now. This is a more complex transaction, but think that partnership interests are specifically prohibited from 1031 treatment. David, what are you talking about? What's that mean? Well, the partnership can do an exchange, but the members of that partnership, and I say members, typically we're talking limited liability companies, for example, and back to that comment on community property states, for example. If, let's say, 5 of us go out together and go buy a property, what do you think the odds of all 5 of us wanting it in 5 years is going to be? Probably not very good. So if we don't want that property as a group, we're going to do an exchange for that partnership. But what happens if 2 or 3 of us want to go over someplace else, and the other 2 or 3 want to go do an exchange? Well, we can't just exchange out of a membership interest. We'd have to do what's called a drop and swap. We're going to drop the people out of that entity that want to go different directions into a tenancy in common ownership. And that should ideally be done maybe a year prior to the sale. Now, that doesn't happen because people don't think about it. They don't call us up and they don't plan ahead. So when do you think we get the call this transaction's happening? Now they got a sale pending, and now we've got a situation where the LLC's got a purchase sale agreement between them and the buyer. And to make that drop happen, you'd have to have the escrow draw a deed from the LLC to the tenancy in common, and then you're going to go back and amend the purchase sale agreement and then go forward. Now, California doesn't want to see that change. Anytime you do that, there's vulnerability because you personally didn't hold the property predisposition. The entity did, but you did not. So you're sort of resetting the hold. And even though I said there's no required hold, it could be problematic. Typically, this drop and swap happens because people just don't want to go forward together at all. We've got a swap and drop, which I'll get to in a second. But if you're working on a deal, let's say in California, they don't want to see an assignment at all. They don't want to see it put in their face that change happened. So instead of doing the simple assignment from the LLC to the tenancy in common, I'm going to tell you in that state, tear up that PSA, write a new one, tenancy in common, selling to the buyers. So at least you don't have that assignment, and that further complicates the transaction, but there's vulnerability there. Now let's say, hey, you didn't think about it, you don't like the risk of doing a drop and swap. Well, the other option is a swap and drop. So we would do, let's say there's 5 of us as members, we want 5 different replacement properties. We're going to do exchange for the limited liability company into those 5 properties. But what we're going to do is probably take and create a new limited liability company for each of those 5 properties. So our exchanging LLC will then exchange into, it will be the sole member of each of those 5 properties. and one of those is purchased for each one of us. After we've completed the exchange for the entity, held it as as that entity as the member of each of those LLCs, those 5 properties, a year after acquisition, maybe we do an assignment of membership interest from the entity to each one of us for each of those properties. Now, the benefit of that is we're not changing title of that property. So if there's financing involved, we don't have to have deeds changed. We don't have title policies that no longer are good or anything else. And I really sort of like that structure for people who are more, let's say conservative than a drop and swap with drop happening at escrow. So you do a drop and swap or a swap and drop, but that's where partnership issues get to be such a problem with that vesting. Even if it's spouses, that's where we've got this issue that comes up. Related party transaction, we talked about this briefly. Related party transaction, typically you can sell to a related party in an exchange, not have a problem. Buying from a related party is where you've got the issue. The only time you can buy from a related party in an exchange is if both you and that related party are doing exchanges and each of you hold your respective replacement properties for no less than 2 years, then we're okay. As I said earlier, there is a little asterisk in there that if you can document there is no effort to avoid taxes, and maybe you don't have a 2-year hold, but this is one of those issues where you got to have good tax people, talk to them and really follow their direction. And I'm sorry, TurboTax might do a great job for tax returns, but they're not going to help you when it comes to making these decisions. And that's why good tax people are so critical to an investor's success in life these days. And I think it just gets more and more important to have good tax people in these situations. Seller finance obviously is something that's there, and I think buying and having a seller do it's great. Buying in an exchange is fine with seller finance, but selling, carrying paper in exchange gets very sticky. In a nutshell, that transaction has to be structured at close. Okay, at close, what happens is we step in assuming all rights and obligations of the seller as the seller of the property. The seller becomes the exchanger. We are the seller of that property. So typically the money all comes to us. Well, any consideration that is given for the purchase of that property has got to be ours at close. So that note would be ours at settlement as well. Now, after that note's become ours, now we could sell the note to a third party. We could use the note to acquire replacement property. We could purchase, I say we're not going to purchase the property. You could purchase, the exchanger could purchase the note from us. And you're going, David, it's my note. Why would I buy my note? What you're doing is substituting cash for the note. And that way we've got the ability to defer all the gain on it. All right. So, if you had a $250,000 note, and you had a $250,000 sitting in the bank, what's the bank paying you versus maybe you're getting 5, well, not 5 in today's world, maybe you're getting 7, 8, 9% on it. If you sell to a weed company, maybe you're getting 20% on it, right? So are you better off, getting, maybe 0 to 5% from the bank, or having a note paying you 7, 8, 9, 10, 20, whatever it might be? So that's why I say you could buy the note, and that's 9 times out of 10 what happens in the situation. 4, maybe it's a short-term note. Maybe the financing for the buyer blew up. Maybe the property's not financeable at that time. So in that situation, a short-term note means that the note's going to mature before we have to acquire the replacement property for you, and that's totally fine. The note's ours. It gets paid off, and we have the cash to complete the exchange. And then finally, we've got the ability to do a partial exchange. So you do an exchange of the cash that came in, and the note would go to you. Now, that only makes sense if the if the basis is at a level where that note is going to shelter or the down payment's going to actually warrant doing the exchange. So you've got to really understand what your basis and gain is and what boot is received in that situation to understand whether the exchange is going to make sense for you. So reverse exchanges. So in a delayed exchange, we sell first and buy later. From the settlement date, you've got 45 days to ID what you want to buy. You've got 180 days total time to complete that transaction. In a reverse exchange, you're going to have 45 days from the acquisition, the settlement date on the acquisition, to identify what's to be sold, 180 days to actually sell the property or those properties. Now, as I said at the top, you cannot legally own the new property and old property at the same time. So do not get yourself in the trap of closing the replacement without engaging the exchange company, all right? You can't own it while you still own the relinquished property. So stop, reach out to the people that you need to reach out to, get the deal set up, and then go ahead and make it happen. So reverse exchange, first thing I'm going to tell you is you've got to have the financial ability to buy the property without having the proceeds from that relinquished property. And then depending on how much money you've got to put down, or whatever financial requirements going to be there, or maybe it's just desirability, whether you want to take ownership of the replacement or the relinquished, that's how we structure either warehouse relinquished reverse exchange means we take ownership of the replacement property. Warehouse relinquished means that we're going to give you direct ownership of the replacement and you're going to transfer that relinquished property to us. So they're sometimes called an exchange first or exchange last transaction too, because if you really, I don't mean to confuse you here, but a warehouse replacement reverse means that we're going to take ownership of that replacement property. The exchange actually takes place when the relinquished property is sold. So we're going to take ownership of the replacement, you maintain ownership of the old one. When the old one sells, you give it to us, we sell it, we give you the new one. So that exchange is done. That's a reverse exchange. Exchange last transaction. A warehouse relinquished, when we buy the property, we're going to convey ownership of the replacement property directly to you, and you transfer the relinquished property to us at the time of acquisition. So that's an exchange first transaction. And in those situations, the exchanges are actually done when those events happen. We've just got to deal with the debts that are incurred, and you're going, what debt? Well, talk about that right now. So what happens with a reverse? What requirements there? One, you can't have ownership of both, right? So we're gonna, an exchange accommodation title holder, that's an EAT. You gotta love all the acronyms we're in these days. So we're gonna create an EAT to take ownership either the replacement or the relinquished property. Within 5 days of that transfer to the EAT, there's got to be an exchange accommodation agreement, a QEAA, Qualified Exchange Accommodation Agreement. Well, we're going to do all that stuff at the time of acquisition before close, actually, and get everything set up. We just don't rely upon that after the fact. We want to make sure it's taken care of. Now, after we've acquired that replacement property, that's when you've got the 45 days to identify what you're selling, and then you've got a total of 180 days to actually close on that property. You, once again, have to have the financial ability to buy that property without having the funds from that future sale. So we're not in the business of loaning money. If you don't have the money to make the deal happen, you're not going to be able to do the reverse. If you've got the money available, great. Now, what are a couple of sources? I just want to hit a couple of quick sources there. I mean, we've had people, did you know that if you got money in a retirement account, you can actually pull money out of that once a year for up to 60 days. So you might take that money out with a 60-day rollover. You take the money out to make that close happen. Now you're up against that 60 days to get the money back in there. But otherwise, you can get money from the bank or wherever it might be to make that transaction happen. But we're going to look at how much money is available to put down versus what's coming out. And that's going to drive warehouse replacement or warehouse relinquished. So seller finance, we talked about seller finance in a delayed exchange and why it's a problem. Well, seller finance in a reverse exchange is not a problem, because what happens is when you go to buy that replacement property in a reverse exchange, you're going to show up at escrow with the money required to buy that property. We actually borrow that money from you. So we have a debt to you for whatever the down payment was or whatever the payment was to us to buy that property. We've got debt to you for that amount as soon as we close on that property. Now, typically that gets paid back when you sell the relinquished property. We take the proceeds, repay the debt, and then any overage we're going to maybe buy down the debt on replacement property, go buy another property. But that's how we take care of stuff in that warehouse replacement reverse. Now, if you sell and carry a note in a reverse exchange, we are going to get that note just like we would that cash. So can we use that note to repay the debt we've got to you? And the answer is yes. So once again, a seller finance situation with a reverse exchange is not a problem. A seller finance in a delayed exchange when you're selling is a problem. So just be aware of that and understand there are, that's one of the nice things about reverses and notes. It can be used and it works just great. So warehouse replacement means that we're going to take, so we've got two ways to do reverse exchanges, a warehouse replacement or a warehouse relinquish. Warehouse replacement means that we're going to create the limited liability company, the EAT, exchange combination title holder, to take ownership of the replacement property. I prefer this structure for a variety of reasons. The first of which is typical that the taxpayer has less money to put down than what they expect to net from a future sale. So that allows us to, take ownership of the new one and pay down the debt and transfer the property to them in the future with all their equity carried forward. Now, the downside of a warehouse replacement is you've got to have if you don't have the cash to buy the property, you've got to have a lender that's going to allow this to happen. It's going to require a portfolio lender, somebody that's familiar with reverse exchanges. If you walk into your credit union, I love credit unions, but they're not going to be able to do the deal. If you walk into, let's say one of the national banks, they don't have a box in their form for reverse exchanges. It's not going to happen. So you're going to be dealing with a portfolio lender, typically a regional bank that you have a relationship with, and those people are going to understand what's going on and be okay doing these things. All right. So just keep that in mind. So that warehouse replacement, you've showing up at that purchase with the money required to buy the property. That money is loaned to us. We close on the property. We own that property from the date of acquisition. You got the 45 days ID what you're selling, 180 days to sell it. When your relinquished property sells, the proceeds of that sale come into us. We take the proceeds, repay the debt we've got to you. If there's additional money, we can then pay down that debt on the replacement property, then convey the property to you, or you could take that balance of money and pay tax on it, or you could go out and buy additional properties. So that would in effect become a blended transaction, because you've got a reverse exchange, and then from the date of close, if you have additional money, you're going to have a delayed exchange from that settlement date. So you have 45 and 180 from the date of acquisition for the reverse, and you'd have 45 and 180 from that sale date to identify and buy any additional replacement property if you want it. Okay, so that's one example of a blended transaction. We're going to talk about improvement exchanges, but this is a structure. An improvement exchange is the same structure as a warehouse replacement reverse exchange. So a warehouse relinquished reverse exchange means that you're still going to show up the purchase with the money required to buy it. We're going to close that property, but we're going to immediately transfer that replacement property to you, which makes the lender happy. And then the property or properties to be sold, those get transferred to us at the same time. So the exchange is done at the date of acquisition. We've just got 45 days and 180 to get that thing sold. We, by law, one of the safe harbors for reverse exchanges, and by the way, we've been doing reverses since we started the company in 1991. We used to do another form that we called a true reverse exchange, but we got the RevProc 2000-37 came into play in 2000, and that gave us the safe harbors for reverse exchanges. One of the safe harbors is that we only have 180 days that we can warehouse a property. So we can't have ownership of the relinquished or replacement for more than 180 days time to work within the safe harbors that 1031 has for reverse exchanges. All right. So the warehouse relinquished just means that it's also that exchange first. We're going to be on title of those properties that are to be relinquished. Now, what happens if they never sell? Well, we're just going to deed them back to you, and you no longer have the ability to exchange out of them into the property that you bought via the reverse. So, keep in mind that that's another reason I like the warehouse replacement better, because we just take ownership. If those properties never sell, we're just going to deed the property to you. If on a warehouse relinquished, you've transferred the properties to us, they never sell, now we've got to transfer them back to you, completing the transaction. So just be aware of those things, and that's really, those are your two options. And if you're maybe selling a variety of properties, you could do a blended transaction too, where you would have a series of properties maybe that started via a delayed exchange. Let's say the first sale, maybe you have 5 properties going away, you have 3 that sell before the acquisition has to happen, 2 that have yet to close. Well, the 3 that were sold pre-purchase, those are coming in as delayed exchange. The 2 that were not sold, you would then be doing a reverse exchange out of those into that same property. And by doing that, you have now stretched your timelines up to a full year, really effectively. So you'd have 180 for the delayed exchange and 180 for the reverse exchange. So that's how you would combine those two into a blended transaction. You can aggregate a number of relinquished properties into a single replacement property by doing that. So I think it's pretty neat to have that flexibility. You know, once again, it requires time and you know, planning, and you really we need to make sure that those properties are all owned in a manner that allows us to do what we need to do too. So blended transaction, we just gave you a couple different examples of blended transactions where we're, you know, maybe we're doing a delayed into a reverse into the same asset, or maybe we're just combining a different, you know, a couple different structures of reverses. Improvement exchanges. So I think it was the Obama administration that came up with the shovel ready comment, right? So, you know, the biggest headache with a 1031 is time. 180 days goes very quickly. I'm going to tell you up and down, you know, I'm talking to you from the West Coast, and I would say whether you're working with Oregon, Washington, or California, you're going to have a hard time building anything in 180 days here if you haven't gotten things started. So, you know, what I mean by that is before anything sells, I mean, the exchange only has 180 days to get something done. An improvement exchange, the property does not have to be completed to qualify, but only what is completed and constitutes like kind real property at the transfer date is going to satisfy 1031 rules. So the idea is that if we're looking up and down the West Coast, for example, if you have not sold anything, but you know what you're going to buy and you know what you're going to build, then I would say, you know, maybe work with the seller of that land and get their okay to go out and start getting the surveys done and you know, start submitting plans and you know, for the permitting process, get everything ready to go. Because if you're in Oregon, it might take you 2 years to get a green light, and you know, it just cracks me up how all our politicians say, well, gee, I want 38,000, you know, our governor wants 38,000 houses built. Well, okay, well, maybe make it easier and cheaper to have happen, and maybe it'll get done. But you know, with the cost of just cost per door is getting ludicrous, plus the time it takes, you know, the amount of money a developer has to put out there over, and I've got a, you know, good friend Steve. I saw you were on this thing. You do a lot of development work, so I mean, you're probably sitting there chuckling or crying about this. But you know, think about how long it takes you from the time you submit this stuff to get a green light to build anything around here. So reverse it, or for an improvement exchange, we only have that 180 days to get things done. So really, you've got to be set to go, because it takes time to build stuff, and so we actually, if we're in Texas, for example, they like to have stuff built. So there, we're going to buy a property, get all the planning, engineering, permitting done. We're actually going to get the shovel in the ground. We're actually going to get things built, and whatever we get built within a 180-day timeline, and whatever is built constitutes like kind real property. That's going to count towards the exchange, including if you've come out of pocket pre-purchase the planning, engineering, permitting. That might be a nice big chunk of capital too, that you'd like to be reimbursed for. That project, if we get that project before it's ever been started, those are all our costs. We can reimburse you those costs and then go vertical with the balance of it. Now, I want to warn you that we can't get to the 180th day and prepay labor and material and get rid of any of that boot situation. So just know that. But you know, those are things that all come up here, and you know, it's complicated. And really, call us, talk to us before you're looking at these improvement exchanges. And it's going to really depend on where you are in this country, whether we're going to be able to do an improvement exchange these days. In the 90s, I did improvement exchanges all the time, and you know, up and down the West Coast. Today, it's really difficult just because you can't even get the green light to go on that stuff. But what happens is we create the LLC, just like the warehouse replacement. We're actually the one that's building that thing out. And then when that 180th day occurs, or just before that, or if we've exhausted all the funds, or we've met your exchange value and equity requirements, we're going to transfer that improved property back to the taxpayer, completing that exchange. So when you identify the replacement property, you're going to identify the project that's being acquired plus the improvements that you intend to build during that improvement period. Okay, escrow holdbacks do not qualify for 1031. That's going to be considered boot and taxable to you. We're really short on time. So this slide and the next are really two different ways you can own a property jointly. People, you know, as I said earlier, we talk about situations with lending and requirements to inject capital into a transaction. maybe you want to buy something bigger, you can actually combine personal money and plan money, IRA 401k funds, into a common investment. You can do it either tenancy in common, or you can do it as common members of a limited liability company. If you're in an exchange, you want to combine personal and planned money into a 1031 property purchase, you keep in mind, anytime we're looking at a retirement account, think of that account as not you. You think of it as Susie down the street. And if we're doing an exchange into a property that's going to be owned by you personally and Susie, your qualified money, that's going to require tenancy in common structure. If you're just going to combine money into a property out of pocket, then you can use the limited liability company. Both of those options have ups and downs. Both are possibilities. Both have pluses and minuses. Few examples and we're done. All right, so I hadn't done this presentation before, so we're actually getting through it okay. Few examples of what we've talked about in play. So this is a situation where, you know, we had somebody come in, they needed to get the deal done, and in their situation, the loan that was going to be there was, you know, requiring the transaction to be owned. It was going to have to be a warehouse relinquished because the lender was not going to allow us to take ownership. And therefore, we had to look for some money someplace. And that's, in this particular transaction, we used a 60-day rollover to be able to buy that property and you know, outright and get them where they needed to go. So actually not outright, I'm sorry, but it gave them the money and the ability to get since we're looking at reverse what was going to be netted out of the relinquish versus the replacement, they didn't have enough in their bank to make that purchase and give them ownership. So we'd warehouse relinquish. So the 60-day rollover gave them the additional capital to get their down payment to be in excess of what their future sale netted. And that allowed us to take ownership of the relinquished property. So that's how we got this deal done. And that's an example of using the 60-day rollover to get them the capital to get the deal done. This transaction, we just looked at it and say, okay, you know, where are we going with this thing? And in this transaction, you know, is really look at your purchase sale agreement. Does it say total cash paid for something, or does it say total consideration? If we look at reverse exchanges or improvement exchanges, they're also called warehouse transactions. And this is an example of a warehousing transaction. Because what happened is we took a property, smaller properties, partial consideration on the sale. Well, our client didn't want that property. So if we'd given them the property, you know, that it wouldn't have been boot to them, but if they sold it, they never held it for investment. It would have had a tax consequence. So by our receipt of that asset, along with the cash, we then took and sold that property. So then we had all the cash to make that person whole. So I'm going to say this again, that at close, anything that the taxpayer receives is not of like kind what they sold is going to be taxed as boot received. Now, even though this building would not have been boot because it would have been a true swap for that piece, they didn't want it. So at time of sale, the cash came to us, the property came to us. We then sold the property and used the proceeds from that sale along with the cash we received from the initial sale to then complete the transaction, making our people whole. This transaction is just a transaction where we look at registrations of things and transfers of properties and our ability to move things back and forth. And we've got, you know, rent control issues, we've got transfer tax issues in many situations. And in this transaction, they had fewer funds available to buy than what they were selling. So we end up doing a warehouse replacement reverse exchange in this situation, because when the future sale happened, we were then able to pay down the debt on the property, then convey the replacement property to them, completing their transaction, and everybody was happy. So once again, which form do we use? Warehouse replacement or warehouse relinquished reverse exchange? In this transaction, purchase must be closed while the relinquished property is not able to be sold. So in this transaction, once again, a reverse exchange was structured, and once again, funds available were less than what the expected proceeds in the future, and we've got a series of transactions happening here, And so we had a couple sales first, and then a future sale later. So we ended up using the blended exchange transaction for this particular exchange. And I just once again stress, anytime you're looking at selling a bunch of properties and going into something, those timelines are going to be your primary concern. Anytime you do an exchange, the timelines are going to be critical, but you're going to work those timelines. And as I exhibited in my previous discussion on blended, we can literally do it over almost a year's time using the delayed and reverse exchange structure. This is, remember at the very beginning, we talked about phantom gains. Now this is something that we haven't had to deal with yet. I'm expecting that as, I really I'm leery of where we're headed in the real estate world right now. And I say that because I think there's lots of people that have never seen a bad day with real estate. And I think there's lots of people that went from, let's say, single family houses into let's say institutional type properties, larger apartment buildings, things like that. Now, the residential transactions, you've got 10, 20, 30-year money, 40-year money, and a commercial property, typically you don't. You might have 5 to 7-year money. It's a different deal. And my concern is, depending on what's happening with the value of the properties, a lot of them might have gone down. You might have a situation where the lenders are going to require a lower loan to value, and you're going to have an effect capital calls. And I think what's going to happen, unless things change, is people are going to be, in a situation where they're looking at having to sell because they can't maybe get a refinance done, or maybe they're in a situation, unfortunately, this has happened a lot the last crash, where they were in a situation where they could not sell or do a refi. And so we ended up in the institutional world doing these phantom gain transactions. And as I said, when we're looking at gain has nothing to do with profit. Gain has nothing to do with somebody receiving cash on a sale. Gain, that phantom gain situation is going to hit you when the debt exceeds the basis. So imagine you've got a property that's going into foreclosure. And we would have these institutional properties where I'd have to do 25 exchanges. I'd have a day to do 25 different LLCs to make the thing happen, and we'd have to do assignments. So a lot of those institutional properties had a series of limited liability companies, Tennessee in common. And in some instances, a servicing agent would be working to refinance a property, and all of a sudden they decide, well, gee, we can't make the refi happen, but we want it. So we'd get a notice, they only have 48 hours before a foreclosure is going to happen. We do assignments of membership interest in those LLCs from the taxpayer to us. That assignment triggered the 45, 180 days, and then that would start the clock for the 1031, like I said, and we'd be going forward. And I said, well, gee, I didn't get any money. Well, what we're doing is we're isolating the taxpayer from actual or constructive receipt of debt relief in this situation. The debt's treated as a sales price. And what happened is this. It's really a simple question to answer. You just say, okay, I can lose a property foreclosure and pay tax for the pleasure of doing it. If you remember at the very beginning, we talked about taxes. Your tax consequence could be as much as 40%. It could be more than that if it was normal income tax. But you think about it, you lose the property foreclosure and you got to come out of pocket 4 out of every, $10 just to pay the tax. Or maybe you do an exchange and you have to come out of pocket $2 or $3, maybe $4. You get something out of it depending on the loan to value. Now, what we're doing in the last crash in the Delaware statutory trust world, there's companies like Inland, let's say, that have these zero coupon offerings that are 80% loan to value, and it's non-recourse debt. We end up structuring the exchange. Person, very easy question to answer. Do I come out of pocket 4 for every 10 and get nothing because I have to pay the tax on that phantom gain? Or do I come out of pocket 2 out of every 10 because those zero coupon offerings were 80% loan to value and I get something? I might not be getting the normal check, the mailbox money, the check in the mail I would with a normal DST. But when that DST goes full cycle, you've got equity that's built up and you get something for it. So just be aware that this thing can rear its ugly head and come up and bite you, and just understand you do have options. You just got to explore them and really give us a call, talk to us, talk to your tax people. Anytime the property is being sold or purchased, really look at what's going on and plan ahead. the old saying with, those who plan to fail, fail to plan, right? So really look at it, take advantage of the experts in your life, and use good counsel. That is it for today. I want to thank you so much for spending your time with us, and hopefully you've got something good out of it. And if you've got questions, don't hesitate to reach out. As I stated at the top, if you want CE, reach out to Seymour at 1031exchange.com, Seymour at 1031exchange.com. Take a look at our social media. If you're wanting information or stay up to date on stuff, you're probably on there because you're on our newsletters. If you're not on them, reach out CC at Seymour at 1031exchange.com. She'll put you on those lists. And hey, take a look at our YouTube channels too and subscribe to that. There's always great information coming out and things that can help you out. So David Moore signing off today. I really appreciate you taking the time to be with us and look forward to talking with you soon. Thank you.